obviously this week, what was more important, what was going on in DC and specifically at 1600 Pennsylvania Avenue. That's where the action is for global capital markets. And, to me, what's been somewhat interesting is, the sequencing of some of the things that are coming out of the new administration. We've always said that sequencing is important, and perhaps that's being heeded to some extent by the new administration. I mean, Steve mentioned there's a deregulatory push. I think that might be stoking corporate confidence to some extent. I mean, the symbolism of having a bunch of tech titans at the inauguration, I think, is interesting, particularly when we see the financial press littered with news about how the technology companies are upping their capex on AI data centers and so forth.
Welcome to RenMac Off Script. We're open to discuss markets, economics, policy, history, and life. The 24th of January, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, we have our Twitter account where you can see a lot of the charts, and you can see us also on our YouTube channel. Search RenMac, and it comes up pretty quickly. So the one thing I learned this week, and I have to say, the MLK holiday falling on Inauguration Day, I found myself watching a lot more of an inauguration than I ever thought I would or probably ever want to again. But for the exact same reason that I watched the debates, which is the exact same reason that I will here and there watch NASCAR, because I don't want anybody to get hurt. But man, when there are those crashes, it is fantastic to watch, right? So, and the only word I could come up with while watching this was excoriating. I mean, that was a masterclass in just absolute beatdown without the ability to rebuttal. I mean, it was unbelievable. So I learned a couple things, and I want to hear your guys' opinion, but I learned a couple things. One, Zuck's a perv. I mean, clearly took the old, the old side eye. I don't even know if it was so side eye. I thought Bush looked like a kid in a Christmas play up there with his expressions. I mean, hilarious, far from presidential, but the cameras are on everybody. I don't know who these people were, but this one woman, and this is not a nice thing to say, but I mean, she looked like she was dead. I don't even know who she was. I don't know if you saw her, but like her skin was gray, and it was frightening. It looked like something out of a TikTok horror movie. Musk couldn't be bothered. If you looked at him, he was kind of like, his eyes were like wandering around. He had no idea what the hell was going on. And then I thought, really the big one was Hillary seems to be in full support of the Gulf of America. I mean, she absolutely, she started laughing around that. I thought it was great. I mean, do you guys have any takeaways? Did you watch it first and foremost?
I'll let Neil go first.
I thought what was interesting for me was that it wasn't just one inauguration. It was a multitude of inaugurations. I mean, he started off very early, at noon, and basically kept going all through the night. So I thought that was pretty remarkable. So, it's always interesting, you listen to the other side. He brought it indoors because he didn't want to be embarrassed by crowd sizes. Yeah, meanwhile, he's getting loads of people watching him at every hour of the day, right? So once again, you can't think straight, and you want to just jump to the worst conclusions because he's your political adversary. But in reality, what happened? You could tune on put the tube on at any time or any social channel, right? And there he is talking. There he is introducing his family. There he is doing his dance with the sword right before he's cutting a cake at the inaugural ball. I just want to apologize to my wife because I think her chances of being the first Indian American First Lady have just collapsed quite dramatically, because at the rate that Usha and JD are going, they're going to be there in 4 years. So I apologize. Usha beat Pooja to it.
I think your I think your skeletons were, may have presented a problem down the road, but we can keep that for a later.
I would have made you sign an NDA.
Fair enough. All right, Steve, what was your take as our political expert? And actually, let me ask you a question. 200 executive orders? I mean, one, that was pretty good showmanship to sit there and do it in front of the cameras and do it in front of the crowd. I mean, that's a masterclass in production for sure. But is that a record? I mean, is that I know this stuff happens all the time, but where does that fall in kind of the litany of historical executive orders?
Well, I guess just in terms of the setting first, the fact that it was inside. I mean, I don't know this for certain. My suspicion is that it probably had to do something with a security threat. Trump already had 2 known assassination attempts on him. So again, it wouldn't surprise me if that might have been one of the reasons that it was moved inside. And because of that closer structure, that's one of the reasons you got a lot of those visuals that you referenced there with the people that you may not have gotten from a more traditional setting outside. In terms of the executive orders, it was a lot, sort of depends on how you count them. I know there was one overturning a lot of the Biden policies, and there were like 70 something of those. Are you going to count that as 70 executive orders? It sort of depends on the count. My understanding is that the president who leads the all-time count is Franklin Delano Roosevelt, although I think he was president for 3 terms, maybe elected for a 4th, I forget that, but simply longevity probably had a lot to do with that. But I look at it just in terms of an investing climate. It's hard for anybody who's looking to make a long-term return on their investment to go ahead and look for some regulatory clarity, because it's just a function right now, regardless of the party. The other side comes in and basically wants to undo everything through executive order. And why have we gotten to that way? It's because polarization. We just can't get durable legislation through the Senate because of the 60 vote threshold, which is why whenever you have these unified government scenarios, everything's sort of focused on trying to shoehorn what you can through budget reconciliation, but there are limitations to that, which is why you're just seeing more falling on the executive branch. So if you are an oil maker looking to recover, or oil producer rather, looking to recover some investment there, is that environment going to change in 4 years? Perhaps that might keep you on the sidelines a little longer. If you're an automaker, what the appetite is for EVs from a regulatory standpoint is going to depend very much on who's there in office. So I think big picture, that was sort of what jumped out at me.
Yeah, the continuity. I mean, in this era of polarization, this just makes it even more polarized. I mean, this is a pro-cyclical polarization tool that, essentially it's a lot more about, something you'd expect from a monarch or a dictator than it is something you'd expect from, parliament or democracy, right? And I'm not saying Trump dictator, like I know the left is going to say Trump dictator. I mean, it happens on both sides. So tap the brakes there. But I mean, it's just it feels like it's something that needs to be managed. Well, let me ask you this: so, what are we going to see first? Reform in that corridor, or reform in the pardoning corridor?
Well, we probably should have reform in the pardoning corridor first.
I mean, if you're gonna
both sides were
ask for a
guilty.
reason, if you could ask for a reason, I think we've hit it. Good God.
Yeah, the presidential pardon powers reached a new low on Inauguration Day, and there was cause on that on both sides. I think there's sort of related issues in the sense that Congress is ceding a lot of its authority to the executive branch now. And, I think it's going to be very difficult for Republican Congress to try to rein in presidential pardons, because Trump's just going to look at it and say, well, what did my predecessor do here? So I don't really have a strong belief that Congress is going to do anything to reclaim their power, particularly as long as Trump's here. And I think he'll have enough support there and sway over the Republican in the House and Senate moving forward.
Yeah. I want to hit Doge, but I don't want to hit that right now. Let's come back to that, because I think it's a really interesting, if people aren't familiar with kind of the inner workings, there's a really interesting path here. We had the World Economic Forum. Neil, I mean, since you're an economist, you want to throw in on that, or is there anything that jumped out of higher priority for you this last week?
No, I mean, I think this is one of these weeks where what was going on in Davos wasn't particularly important. Not that it really ever is. I mean, I can't ever recall in my entire career as a business economist where I ever gave um, a damn about what was going on at the World Economic Forum. It was sort of this is where people that like hearing themselves talk go to hear themselves talk. So I don't really put much weight on it one way or the other.
Self-important elitists. So let me ask you, and I think I know the answer to this question, but of the two, Davos or Jackson Hole, which do you find more, I guess, I don't know, say respectable. That's not the word I'm looking
No,
for.
Jackson
Maybe
Hole.
more
I mean,
legitimate.
that's not even that's an easy question. Obviously,
Yeah, I
this
know.
week, what was
I
more
knew it.
important? What was going on in DC and specifically at 1600 Pennsylvania Avenue. That's where the action is for global capital markets. And to me, what's been somewhat interesting is the sequencing of some of the things that are coming out of the new administration. We've always said that sequencing is important, and perhaps that's being heeded to some extent by the new administration. I mean, Steve mentioned there's a deregulatory push. I think that might be stoking corporate confidence to some extent. I mean, the symbolism of having a bunch of tech titans at the inauguration, I think, is interesting, particularly when we see the financial press littered with news about how the technology companies are upping their capex on AI data centers and so forth. I mean, there was a headline just this morning about Facebook or Meta doing that. The stock is down on that news, but so I think it's kind of interesting. But to the and at the same time, the headlines are also showing I don't want to have to do tariffs on China. Right. So a little bit more of this is the kind of core tension, I think, in some regards, because President Trump wants the stock market to go up, but he also wants to do tariffs. And at some level, you can't have both, right? Because if you do tariffs, you're kind of binding the stock market to some extent, right? So that threat of tariffs is almost like, I don't know, like an options collar, right? I mean, you kind of, you want the stock market to go, but if you do tariffs, then the stock market might go down. So, I mean,
Yep.
that aspect of it, so to the extent that they're focusing on more growth-friendly initiatives, I think is notable. So I think that for me on the policy side, that's what's important. Obviously, all the usual suspects lost their mind when at Davos he said, "I demand lower interest rates," and then he talked about. But again, it's like anything else. I mean, with Trump, it's like there's always a little bit more to it than what the headlines read. So obviously the usual suspects light their hair on fire. I mean, how could he possibly demand lower interest rates? I mean, this is someone that's always said that he wouldn't make his opinions unknown. I mean, he's never been shy about letting his opinions be known, and I think that's part of what's going on here. But it's notable that he tied the rates comments to oil, right? Trump wants lower oil prices and he wants lower interest rates. Now, can you tell me whether those two things are incongruent? I don't think so. I mean, he wants a positive supply shock in oil. Now, maybe that hurts some of the domestic producers. I mean, that's an interesting kind of discussion. But I mean, maybe you have additional sanctions on Iran, and that means that Europe, that Saudis and the U.S. pump more. I have no idea. But what he wants is a positive supply shock in the energy markets. If that happens, what's going to go on with inflation, right? I mean, inflation expectations will come down because a lot of what drives inflation expectations is gas, the things that people spend their money on quite often. And that in turn, if you have lower inflation expectations, that in turn brings down rates. So contrary to some, Trump is not, in fact, in my opinion, saying a bunch of random things. He is, in fact, making some sense. Lower oil prices and lower rates are two wants that aren't exactly at odds with each other. So I think that's notable. That's not to say that there aren't things that they want to do that aren't at odds with each other. I mean, you can't want a weak dollar and then, increase the deficit and so forth. But wanting lower oil prices and expecting lower rates is not exactly a crazy thing to.
Well, I mean, look, when you're building an economic model, right, and you're strong at this, obviously, but the two important inputs that if you just want to keep it as simple as you could without losing efficacy and without making it too complicated is oil and short rates. I mean, it's pretty clear, what the primary drivers of growth are. And so, yeah, I mean, he's going right to the source and attacking those two ideas. Obviously, one he has more influence on than the other, but it is historically the right way to think about it. I would just question: is it tech titans or Silicon Valley sycophants? Which one do you think it is now?
I don't have an opinion on that.
I know. All right. So let's spin this back to Doge, because I think this is an interesting curveball. So I think there are already lawsuits, right, about creating the Department of Government Efficiency, and that seemed to have been usurped by somebody in the administration, probably with a law degree and certainly with a certain creative chutzpah that figured out an end around. You want to just give us the executive summary on why Doge is not going to be really Doge, but also is instantly legitimized from day one?
Sure. So going into Trump's inauguration, most people, myself included, thought that the Doge was going to be structured as an outside sort of federal advisory committee, similar to like what was Grace Commission under Reagan or Simpson Bowles under Obama, where an outside government structure just to make recommendations to Congress. What was announced later in the day during Trump's inauguration was an executive order that actually renamed an existing department. I believe it was the U.S. Digital Services that was created under Obama to help deal with some of the fallout from the Affordable Care Act exchange when it was rolled out, a lot of technical glitches. So it sort of used this existing structure within the executive office of the president to focus, that's already focused on technology delivering efficiencies, and they just renamed it, I believe, the U.S. Doge Service. So now, because of that structure, all these lawsuits that were filed on that day are no longer, I don't even know if you have standing. Again, I'm not a lawyer, but it's not a federal advisory committee. So all these
very stable,
yes.
Genius.
Yeah. Well, not sure whether you're crediting Musk, Trump, or whomever on that, but whoever thought of that was pretty creative. Also, too, because now you work at the executive office of the president, you are not going to be bound by a congressional subpoena request. So that will help with some of the oversight because of the technology sharing requirement that should give Musk and other Doge members more insight as to what's really going on there in some of these departments. It's also worth noting that Vivek Ramaswamy was going to be the co-leader of Doge, is no longer going to be part of that. There's Wall Street Journal reporting suggesting that the two, both Musk and Ramaswamy, clashed several areas, one of which was his structure. I guess Ramaswamy wanted it more to be that outsider proposal and also want to focus more on regulations, where I guess Musk wanted this structure and also wanted to focus more on spending cuts. So he since walked back this desire to cut $2 trillion, suggesting sort of that's more aspirational. $1 trillion probably may be more realistic. We'll see about that. But again, I think you like to use that analogy, Jeff, of the other team is going to blitz and you throw the screen pass over the front there, and that was a good.
I think, Steve, I think that Nikki Haley was onto something.
Well, disagreeing.
About Vivek, that he's basically very, very annoying, and that's why he got pushed out.
I was going to say, of those two, there's not enough oxygen in the same room for those two to coexist. I mean, that, somebody was turning
also, Vivek kind of stepped into it on Twitter with this whole cultural rant against. God, if America's that bad, why are people coming here in the first place? I mean, it's sort of ridiculous. But at any rate,
he didn't do himself any favors to endear himself with a large part of the base. That said, there's a lot of speculation as to how long the bromance between Trump and Musk can last. It was interesting after the AI announcement that Trump made involving one of Musk's nemesis, Sam Altman, with OpenAI, that Musk sort of was very quick to go to X and criticize the deal. And I don't know that that sat well with a lot of Trump's advisors there. But at the end of the day, does Musk really need this? A lot of people, just to be honest, are working in an administration, regardless of party, to enrich themselves after. That's not the case for Musk. He doesn't need the money. In fact, I don't know that money's really going to motivate him when you have that much. So
well, so far it's worked out pretty well for him, though. I mean,
no, it did. It did. He made a good investment on this, and I don't take that away. I'm just saying, in terms of does he have enough to walk away potentially from Trump? That may put him in a position that may be rather unique to him as opposed to others.
Yeah, no doubt about it. But I mean, look, I think people one way to tolerate Trump, I think, is just understand that he loves to live outside the box. 98% of people, just human nature, are creatures of comfort. They want to be inside the box. Trump doesn't live that way, right? He lives outside the box. And so it's just very disturbing for 98% of the population. The other part of it is exactly to that point, which is he's very good at drawing you in and making you look over here and then throw the ball over the oncoming blitzing linebackers and scoring a touchdown, right? So, you just got to be prepared for it. He doesn't take the kind of logical course of action, which is why he's been a fairly successful businessman. I know that that's questionable too, but anyway, that's gives you a little bit of kind of behavioral insight on how this guy operates. Well, I mean, I when I heard that, I was just like, that is really a very well done end around to any of the opposition that's out there, and whether you support it or not, which I don't know how you couldn't support more government efficiency, but you have to give it its due credit with the tip of the hat to the creativity there. Let's talk a little bit about the market. So we made a new high, and I thought probably the most interesting thing was that the STOXX 600, which is the European kind of S&P 500, if you will, also made a new high, and that was lagging. I mean, that was struggling. We had a dark cross back, I think it was in December, it might have been November, for the STOXX 600. And the good news around that was it was not being reflected in banks. So the financial system in Europe seemed to be not only stable but relatively thriving, and obviously the market responded and broke out, and that's in the face, obviously, of the war in Ukraine, energy prices, Trump tariffs, etc. So, good things seem to be happening there, which I think is, look, if you're going to be bullish in the U.S., it's helpful that other markets globally are also in bull markets. So we do certainly like to see that happening. The overbought condition in energy has started to soften here a bit. That's exactly what we'd expect. We'll see if it goes on to make a new low. Relative performance really didn't change much with this strong rally that we've had since the beginning of the year. So no changes there, which I think is important. And I want to get Neil's opinion on this, but certainly from our perspective, this punch through the new high on the S&P, which, by the way, 20-day highs ran about 23% here yesterday as we made that new high. We did get to a peak of 47% early in the week. You want to see that number well above 50%. That's a sign of breadth. So we're not getting that yet, and that'll be important to kind of the duration of this rally and how comfortable we feel for how long. Kind of think about it like a shot clock in basketball. You get that 50+%, and you reset the shot clock, and it usually gives you months of duration. But I do think some of this strength has taken place as we've seen this contraction in 10-year yields. In my mind, the durability of the rally is going to have a lot to do with whether or not yields are stable and declining, or whether or not they have in fact entered a new longer-term uptrend. So we want to see that. Obviously, what we're seeing in these names, you had rallies in things like building products, you had rallies in things like home builders. Those are now overbought in what we describe as downtrends, and I do think again that the 10-year yield will be important, not just to those obviously hypersensitive industry groups to the bond yields, but also for the overall market. Our yield impact model was pushing up against that kind of barrier that said that bonds were a decent value versus the earnings yield on the S&P. But Neil, as you kind of look around, and I know energy is important, obviously, and the desire for lower rates. Clearly, it's harder to to manipulate or control the longer end of the curve than it is the shorter end of the curve. But as you kind of sit back and look, are you more comfortable with rates lower or rates higher, or maybe even rates stable as a third option as the data, and maybe not even just the data, but the trajectory of the data comes in here over the last 3 to 6 months?
I mean, I think for me, to the extent that longer term rates are just expectations of future short term rates, there's probably more reason to expect longer term rates to come down, because the markets are currently pricing in not even 2 rate cuts this year. And I think we probably get a little bit more than that. So, Governor Waller was talking about 3 or 4 cuts. But if you look at the tone of the data, I think there's a little bit of angst around inflation at a time where it's increasingly likely that inflation will moderate. When you look at, importantly, rental inflation, most of the sort of leading indicators for rents continue to point south. So that's a huge chunk of core inflation, obviously. And whether you look at the all tenant rent index, CoreLogic single family rent index, I mean, these are all pointing lower. And so to me, it stands to reason that inflation is likely to moderate. And remember that rents are basically the primary reason for why there's a shortfall for relative to the Fed's 2% target. At least on the upside. So to the extent that those areas normalize, you're going to get a convergence towards 2% more quickly than the markets might be anticipating at the moment. In terms of the data, the December data flow was all very, very strong. Now, it's hard to know whether that's just sort of industrial production was boosted by Boeing. You had a big increase in multifamily starts. It's hard to know how much of that is durable and how much of that is just sort of a one-off kind of story. I have continued concerns around the housing market. I simply do not think that housing can work with interest rates above 7%, because no one's getting wage growth of anywhere close to that. So real mortgage rates have exploded. And that just means that there's an affordability problem. And right now, you have inventory that's come onto the market, but not as much sales. That's not exactly a good combination. So it may be one reason why price expectations have been coming down, but you're getting now to a point where we're entering the spring selling season, and rates are above 7%. That's not really a good place to be, I don't think. So I do think housing remains under pressure. Capital spending intentions have been better. I mean, that's been encouraging. We'll see how widespread that is. Obviously, there's a lot of information or news coming out about tech capex, right? AI capex, for example. And the last thing I would say is labor markets. I think labor markets are continuing to slowly cool. I mean, certainly you see that in headlines. I mean, anecdotes, right? Meta, Microsoft, I think Southwest, Stripe. I mean, you have a number of companies, that are letting people go. And yeah, I mean, I would say that labor markets are still gradually cooling, and that'll keep the onus on the Fed to maintain dovish bias, I think.
Steve, what do you have on the docket next week?
2 things jump out at me. One, House Republicans will be holding their policy retreat in Miami, Florida, and that's where they're trying to come together on this reconciliation package, and that's going to include a lot of the tax proposals. And one of the things that I'd watch out for is this idea that's apparently gaining some steam in terms of removing, when you're scouring the couch cushions, you need to find revenue. And if you talk about removing the federal exemption for municipal bonds, that may be getting more traction than people think. So be on the lookout for any movement there. And then later in the week, I believe following Saturday, February 1st, that's a new tariff, self-imposed tariff deadline from President Trump. Obviously, he didn't follow through on his day one threat, issued sort of an executive order just asking for studies. But, he threw this out here. And sort of pros and cons, obviously, there are 3 things that sort of you can get out of tariffs. You get concessions, you get revenues, you can protect favorite industries. And with Trump, it's not always clear which one of those he's trying to pursue. And I think there's also a risk at some point, if you continue to put threats out there, do you become the boy who cries wolf? And I guess that's in the back of Trump's head. That said, he doesn't have a team in place. So if he follows through on the tariffs and we get some sort of retaliation to be expected on one of the recipients, do you really have your team staffed up yet to engage in that thing? I'm not sure. So my guess is this is really focused on trying to incentivize Mexico and Canada to come to the table a little earlier, because I think he wants to address the issue of China circumventing U.S. trade restrictions, give them stronger leverage at some point to pivot to China. So I'd be surprised if we see much after February 1st. If we see anything, I guess it'd be Canada and Mexico. So I guess that's sort of what I'm keeping an eye out for.
Neil, any data points next week that are worth noting?
Yeah, it's a big week, actually. We get the initial estimate for the fourth quarter in terms of GDP growth. Markets are looking for 2.6%. Atlanta Fed's tracking around 3%. Obviously, that'll be notable. The first pass on GDP for every quarter usually is. We'll also get data on consumer confidence. If you look at the high frequency data on consumer sentiment right now, it's kind of it's a bit of a mixed bag. On the one hand, you have stock prices going up. On the other hand, you have grass prices going up. And so those two things are kind of in tension. The high frequency data we look at, suggests that confidence is basically flat, moving sideways. And we have a Fed meeting next week. It's widely anticipated that the Fed does nothing. We'll see what they say about the outlook and how they're thinking about the coming quarters. There is a little bit of a debate, among the Fed participants. I mean, on the dovish side of the spectrum, you have Governor Waller, who's basically saying that he doesn't really see much of an inflation threat from tariffs, saying it's possible that if the data continues to come in the way it has on the inflation side, that you see 3 or 4 rate cuts. We will get another core PCE number next week, on the other hand, you have a bunch of Fed officials that are kind of in wait and see mode because they're concerned. They're talking up the strength in the economy and potential threats from future policy. So those tensions and how Powell will navigate them, I think, is going to be interesting.
Well, we'll be watching levels as always. Cyclicals versus defensives still in vogue, still leading. That's good news. It's consistent with our market cycle clock. Look, new highs in the S&P are always better than not. And so, when you get those, there has this, the markets have this ability to auto-correlate. What that means is momentum, new highs beget new highs. 57.75 is the support level that becomes important now, that really help to corral the latest weakness, and that will serve as important support as we go forward. I do think the continuation of focus on the 10-year yield will be important. 480 is the resistance level. Up there, we start pushing against our yield impact model. Down below 450 would be welcome and good news, as it would help to support multiple expansion as we go, and obviously just loosen up some of this tightness that is embedded in the system with these rates. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and YouTube if you want to see our faces during this pod. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.